This is the first in a short series of videos I'm going to do on inheritance tax, or IHT as it's more commonly referred to. So IHT will be applicable to the value of anyone's estate when they die, and their estate is made up of all the assets they own. So that's savings and investments, property, be it a main home or holiday homes, buy-to-let properties they might own, and chattels. So that's anything like artwork and jewelry, anything that's movable property. It isn't actually applicable to pension funds, which makes pensions that much more efficient from a planning point of view. Now, if inheritance tax does apply on someone's estate, it is taxed at 40%. And the simple rule of inheritance tax planning is you can't have your cake and eat it. So if you want to retain control of an asset, it is potentially part of your taxable estate. If you want it outside of your estate, then you have to give it away. A good example being your home. If you wanted your children to benefit from your home and not pay inheritance tax on it, and you wanted to give it away, you couldn't continue to live in it without paying a fair market rent for it. Now, it's not necessarily that all of your estate is taxable to inheritance tax, because everyone has what is called a Nil Rate Band, and the current Nil Rate Band is £325,000 per person, and that is per person who dies rather than per beneficiary of an estate. Where you have a husband and wife or civil partners, it is possible to transfer any unused Nil Rate Band from the first person to die to the survivor, which means that the survivor, when they die, their Nil Rate Band is up to possibly £650,000. So any assets below £650,000 would not be applicable to inheritance tax, and any assets over that £650,000, for that 40% inheritance tax would apply. And as I'll cover in a future video in a bit more detail, we now have something called a residence Nil Rate Band, and that is where a qualifying property, a main resident, benefits from a higher Nil Rate Band, an additional £175,000 per person, meaning that for husbands and wives where the unused Nil Rate Band is passed on to survivor, the potential total Nil Rate Band could be £1 million. And again, subject to a future video is these PETs and CLTs. So PET stands for potentially exempt transfer, emphasis on the potential. That is any gifts that are made in a lifetime that might mean that they are exempt from inheritance tax, more commonly known as the 7-year clock rule. Chargeable lifetime transfers, CLTs, are where gifts are made in someone's lifetime. They're greater than a Nil Rate Band, so more than £325,000, and they're made to a discretionary trust. So immediately the amount over £325,000 is taxed at 20%. And again, the subject of another video is what gifts and exemptions apply. But simple point for this video is you can make number of gifts, which would mean that you can move assets out of your estate and inheritance tax wouldn't apply. And there's some annual exemptions to consider as well. And finally, we can use trusts to manage how our estate is passed on to our beneficiaries. It doesn't necessarily make it more tax efficient, but it gives us control over who receives the estate, the assets, and when. So we do manage to get a bit of control and flexibility over our estate from that point of view. But again, I'll cover that more in a future video. So that was a quick video on the IHT basics. Please do look out for these other ones I'm doing in the series to give you a bit more understanding about inheritance tax and the rules around it. Thank you.